Welcome to The Deep Dive, your shortcut to being genuinely well-informed. Today we're diving deep into the Q2 2025 earnings call from ROST Stores. We've gone through the reports, listened to what management had to say, checked out the analyst questions, basically boiled it down for you.
That's right. Our mission today is really to dissect the key numbers, understand the strategies management is talking about, and look at the outlook for ROST, especially, as they navigate this pretty complex economic backdrop. We want to pull out the most important nuggets for you.
Right, so you understand not just what happened, but why it matters for a company like this. Okay, let's unpack this then. Starting with the headline numbers for Q2 2025. What did ROST Stores report?
Well, they delivered an earnings per share of $1.56. And that notably beat the consensus estimate of $1.53. So a nice beat there on the bottom line.
Okay, an EPS beat. What about the top line? Revenue.
Revenue came in at $5.53 billion. That was actually a slight miss against the $5.54 billion expectation, but it still marked a solid 5% increase compared to last year. So growth is still there.
Got it. 5% year-over-year growth, even with a slight miss. And comparable store sales.
Comps were up 2% year-over-year, respectable.
Okay. So EPS beat, slight revenue miss, comps up 2%. Now, what about profitability? The operating margin. I heard there were some pressures there.
Yeah, there were. The operating margin saw a decrease, 95 basis points down, landing at 11.5%.
Almost a full percentage point drop. What drove that?
It primarily reflected a really significant negative impact from tariffs. We're talking about $0.11 per share just from tariff-related costs this quarter.
Wow, face for 11 cents is substantial.
Okay.
Anything else major on the financial front? Store openings, buybacks?
Yep. They continued their store expansion, opening 31 new locations in Q2. And they kept buying back stock, repurchased 1.9 million shares for about $262 million. That keeps them on track for their big $1.05 billion repurchase target for the whole year.
Okay, so despite that tariff hit, the EPS beat is interesting. Let's dig into the details a bit. What drove these numbers? Management mentioned something about sales trends improving sequentially within the quarter.
Yeah, that's actually one of the more fascinating parts. They saw really strong performance back in May. Then things softened a bit in June, which caused some concern, I imagine. But then July saw a sharp rebound. And they're viewing that July strength as a positive sign, especially heading into the back-to-school season.
Okay, so a bit of a roller coaster within the quarter. Was this improvement broad or specific to certain areas?
Pretty broad-based, actually, across nearly all the major merchandise categories and most geographic regions. Cosmetics was apparently the best performing area, which is interesting. And the ladies' business, which is a big focus for their branded strategy, had strong positive comps, even better than the overall chain average.
So that broad strength, especially in ladies' apparel and that July bounce, suggests their core strategy is working, right, as people get ready for fall.
Seems like it. It suggests they're hitting the right notes on merchandise.
Were there any, specific customer groups or regions that stood out, either performing really well or maybe lagging?
Geographically, they called out the Southeast and Midwest as the strongest markets. And here's an interesting detail. Stores with a lot of Hispanic customers, particularly down in Southern California, actually underperformed in that weaker June period. But then, like the overall trend, they saw a significant bounce back in July. Management kind of tied this to broader regional economic sensitivities.
Interesting nuance there. What about merchandise categories? Any shifts?
Well, besides cosmetics and ladies doing well, the home business, which had been dragging down comps, that actually turned slightly positive by July, too.
Okay, so home is starting to stabilize.
Yeah.
And how did the two store brands perform? ROST versus DD's discounts.
Both saw growth in traffic and average basket size, which is good. And DD's discounts actually posted comparable store sales that were ahead of the main ROST chain. So DD's had a particularly strong quarter.
Right. Okay, let's circle back to tariffs. You said it was a huge drag, 90 basis points on the operating margin.
Yeah.
How are they actually fighting that? What are the mitigation strategies?
Yeah, it's a major headwind. They're using a multi-pronged approach, as they put it. First, aggressive negotiations with vendors, trying to push back on price increases. Second, diversifying their sourcing moving production away from the most heavily tariffed regions where possible.
Makes sense. What else? Pricing? Closeouts?
Strategic price adjustments, yes, but they're being very careful not to hurt their value image. We'll probably talk more about that. They've also leaned more heavily into closeout merchandise. That stuff inherently has better margins, so it helps offset some tariff pressure.
The treasure hunt aspect potentially gets even better margins. Clever.
Exactly. And one other thing, they temporarily stopped vendor pre-ticking.
Pre-ticking, meaning the price tags put on by the supplier.
Right. Stopping that gives Ross more flexibility to set prices in store based on the current environment. It did hit distribution costs in Q2 because it adds work in their DCs, but they expect that to normalize by Q4.
So looking ahead, how big do they expect this tariff hit to be for the full year? And when does it sort of settle down?
They're guiding for a total full-year impact between $0.22 and $0.25 per share from tariffs. But importantly, they expect that impact to decrease sequentially through the second half of this year. And the goal, or expectation, is that by 2026, it just becomes part of the normal cost structure, a new equilibrium of prices, as they called it, not this separate big headwind.
Okay, so managing the controllable costs. What about growth drivers? Beyond just dealing with tariffs, what strategic moves are they making for the future?
Well, number one is definitely store expansion. They're still aggressive there. On track to open about 90 new stores this year. That includes their successful launch into Puerto Rico with 3 stores and several new ones in the New York metro area, both apparently doing really well.
90 stores is quite a pace. Are they doing anything with the existing stores?
Yes. They're also modernizing the existing footprint with what they call store refreshes. Think new signage, cosmetic repairs, just sprucing things up. They plan to hit about 50% of the chain this year with these refreshes, and the goal is to have the entire chain refreshed by 2026.
50% this year is ambitious. Anything else on the in-store experience front?
Self-checkout. They're piloting it in about 80 stores right now.
Self-checkout at Ross. That could be huge for wait times. How's that going?
Apparently, the customer response is positive, and they feel they have good control over potential issues like shrink. So the plan is to expand it next year, focusing mainly on their higher volume locations. It's about improving throughput, getting people checked out faster.
Definitely needed in some locations. And marketing. Any changes there?
Yeah, new campaigns rolling out. Work your magic for Ross and don't sleep on B for Deeds discounts. The goal is to reinforce that core value message and the sort of emotional connection, the treasure hunt appeal.
Okay, store growth, refreshes, self-checkout, new marketing. How does this all tie back to their value proposition in this inflationary time? Are they holding the line on prices?
Very much so. That's a huge focus. They talk about maintaining their price umbrella, that gap between their prices and traditional retailers. They're being really cautious with price increases, aiming for just low single-digit bumps in the average price per item, the AUR.
Low single digits.
Yep.
So they're absorbing some cost increases to maintain that gap.
Essentially, yes. The CEO, Jim Conroy, basically said they want to remain the best bargain in the market. The bet is that this strategy lets them grab market share, especially during big shopping seasons like back to school, even if it squeezes margins a bit short term.
Prioritizing share over short-term margin. Makes sense in off-price. Okay, let's pivot to the outlook. What's the guidance for the rest of fiscal 2025?
They're keeping a somewhat cautious approach, is how they framed it. Macro uncertainties are still out there. For comparable store sales, they're projecting 2-3% growth for both Q3 and Q4, so similar to Q2.
And the bottom line, earnings per share.
Full-year EPS guidance was revised down slightly. It's now in a range of $6.08 to $6.21. That's down from $6.32 last year, and that revision mainly reflects that full-year tariff impact we talked about, the $22 to 25 cents per share.
Got it. Any specifics on Q3? It sounds like there might be some particular headwinds there.
Yeah, Q3 EPS is projected between $1.31 and $1.37. It's going to be impacted by a few things. Estimated tariff costs, obviously. Also, some unfavorable timing of pack-away-related costs.
Pack-away costs, remind us what that is.
That's basically the costs associated with buying inventory well in advance, often opportunistic closeout deals for future seasons. Sometimes the timing of when those costs hit the P&L can create lumpiness between quarters.
Okay, so tariffs and pack-away timing.
Yeah.
Anything else in Q3?
And continued deleverage from that new distribution center they're ramping up.
Ah, the deleverage. You mentioned that's when the fixed costs of a new facility haven't been fully absorbed by volume yet, right?
Yeah. Exactly. It's a temporary drag while the DC gets up to full speed. The good news, though, is they expect these specific Q3 headwinds, the packaway timing and the DC deleverage, to mostly reverse or normalize in Q4.
Okay, so some near-term noise in Q3, but expected to smooth out. Looking further out then, what's the long-term growth story they're telling?
Well, the target hasn't changed. They aim for a long-term EPS growth algorithm of around double digits.
Double digits. How do they get there?
It's a formula, essentially. About 5% new store growth annually, which they figure adds about 2% to EPS growth. Then 3% comparable store sales growth, adding another 3% or so to EPS. And finally, stock buybacks contributing another 2-3% to EPS growth. Add it up, and you're around that 10% mark.
Okay, 5% unit growth, 3% comps, 2-3% buybacks. And they still see room to grow the store base.
Oh, yeah. Management sees significant white space, meaning untapped markets, for potentially even faster store growth down the line, assuming their supply chain can support it.
Right. Okay, so let's bring it back to the market context. You mentioned the reaction was a bit mixed initially, but then turned positive after hours. What does that suggest?
I think it signals a sort of neutral to cautiously optimistic view from the market. On one hand, the EPS beat and that strong July rebound are definitely encouraging, shows resilience. But the market is clearly still weighing the ongoing macro uncertainties and those tariff pressures on margins.
And how has the stock performed lately?
It's actually underperformed the S&P 500, both year-to-date and over the trailing 12 months, which suggests that even though off-price retailers are generally seen as well-positioned in inflationary times, the specific headwinds facing ROST, like tariffs, have made investors a bit more skeptical compared to the broader market.
That makes sense. Any other context investors should be aware of? Management changes.
One key thing is the upcoming retirement of the CFO, Adam Orvis, at the end of September. Bill Sheen, who's currently deputy CFO, is stepping into the role, so they're emphasizing a smooth transition. But it's still a change in a key position to watch.
Definitely something to keep an eye on. Okay, this brings us to our signature "This is not financial advice" segment. Time for that outrageous but plausible trade idea. Imagine you're pitching a hedge fund committee on ROST. What's the play?
All right, team, listen up. ROST. The street's view is, let's face it, cautious optimism. Tariffs, macro risks. It's kept the stock lagging the S&P. We saw the Q2 results, EPS beat, slight revenue miss, but Q3 guidance. It clearly flags more margin pressure, pack away timing, that new DCD leverage, even with slightly lower tariff impact sequentially. The market is likely pricing in that Q3 pain right now, maybe even overpricing it.
Okay, so the market's focused on the short-term Q3 squeeze. What's the counter-narrative, the outrageous play?
The outrageous but plausible trade idea. A Q3 de-risk and 2026 re-rate long equity position hedged with short-term put options.
Okay, long ROST, but with a hedge. Walk us through the mechanics. How do you structure it?
The play. We initiate a long position in ROST equity. Maybe wait for late September, early October, let any CFO transition jitters or Q3 worries potentially push it down a bit more. We're betting the market is too focused on these temporary Q3 issues. Simultaneously, to protect against unexpected shocks or more short-term jitters around that time, we sell some out-of-the-money put options expiring mid-Q4.
Selling puts. So you collect premium, betting the stock doesn't crater below a certain level before those puts expire in mid-Q4. What's the core rationale? Why does this work long-term?
Exactly. The rationale. Look past Q3. Tariffs are expected to normalize by 2026, become part of the baseline, not this scary line item. Meanwhile, the store refresh program hits 50% this year, 100% by 2026. Self-checkout expands. ROST becomes a leaner, more efficient machine. Suddenly, that long-term double-digit EPS growth algorithm driven by steady store openings and comps looks much clearer, less noisy.
So the Q3 stuff is temporary noise obscuring the real story.
That's the bet. Remember, those specific Q3 headwinds are expected to flip back in Q4. This position lets us get long for the market eventually re-rating ROST based on that clearer long-term growth potential as these catalysts play out. The payoff. We could see maybe 20-25% price appreciation by mid-2026 as the stock catches up, closes that gap with the S&P. It's a bet on solid execution and structural tailwinds winning out over temporary, known headwinds.
A bet on the noise fading and the fundamentals shining through. Interesting. Okay, let's recap the key takeaways from ROST Stores' Q2. It seems they delivered a pretty resilient quarter. Beat on EPS, showed agility navigating those tariff headwinds with various strategies.
Right, and that sequential sales improvement, especially the July rebound, shows they're still competing effectively, connecting with value-conscious consumers.
Their strategic moves, store growth, the refreshes, piloting self-checkout, combined with doubling down on their value proposition, seem to be laying the groundwork for future growth.
Definitely. Even though the cautious near-term outlook reflects those macro uncertainties, that long-term double-digit EPS growth story is still the powerful undercurrent here.
So ROST is clearly steering through some choppy waters, using operational discipline and strategic bets. The lingering question, I suppose, is whether that focus on value and expansion can truly overpower the broader economic concerns and tariff issues, or if the market's caution is warranted for now. It's a real test for the off-price model. We hope this deep dive has helped you connect some of those dots and form your own view on ROST stores. And of course, remember, the insights shared today are purely for informational purposes. They're absolutely not financial advice. Always do your own research.
Until next time, stay well informed and keep digging into those earnings reports.